Order blocks are one of the most powerful concepts in the liquidity concept in trading, but most traders still don't understand how to identify or use them correctly. In this masterclass, you'll learn what order blocks really represent, how to identify valid ones, and how they connect to how professional traders approach the market through supply and demand and liquidity. Hello traders, welcome back to the ComLucro channel. In today's video, we'll take it a step further and show you exactly how to trade order blocks using a structured strategy, combining market structure, multiple time frames, and confirmation to execute with precision and consistency. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now, let's begin with the basics. What exactly is an order block? Order blocks are essentially refined or optimized supply and demand areas. From basic price action theory, we know that the market always moves in a rhythm of impulsive and corrective waves, shaped by the collective behavior of market participants. We identify the starting point of an impulse as a demand zone. This happens because in that area, traders have previously entered long positions with a clear intention. When price returns to the same demand zone, there is a higher probability that those traders or new ones recognizing the opportunity will start buying again. Simply put, demand zones highlight areas where we expect buyers to step back into the market. Likewise, the beginning of a downward move is identified as a supply zone, where traders have previously taken short positions. When price revisits this zone, it often leads to renewed selling pressure. In other words, supply zones are areas where we expect sellers to become active once again. Now, order blocks are a special type of supply and demand zone, but they form when a large number of buyers or sellers enter the market at once, creating a visible imbalance in price. This imbalance between buying and selling pressure can often be identified through what we call fair value gaps. These gaps appear when price moves too quickly in one direction, leaving certain orders unfilled, and the market may later return to those areas to restore balance. We usually mark the candle that appears right before the gap as our order block zone, because that is where major trading decisions were likely made. When price comes back to this order block, we often see a strong reaction as institutional buyers or sellers re-enter the market. So in essence, order blocks are still supply and demand zones, but the key difference is that we focus specifically on areas where larger institutional orders were placed, revealing where the real smart money operates within the market. However, understanding this concept alone is not enough to apply it effectively in real market conditions. So before we can actually apply order blocks in a practical way, we first need to understand how to correctly identify which ones are truly valid. Earlier, we mentioned that strong price movement away from an area can point to an order block. However, it is important to clarify that this alone is not enough. A significant move by itself does not automatically confirm an order block. There are specific conditions that must be met for an order block to be considered valid. With that in mind, there are 3 key rules used to define a valid order block. These rules are essential because without them, it becomes very easy to mislabel random price movements as meaningful structures. The first rule focuses on the presence of a fair value gap. For price to qualify as an order block, it must create a fair value gap immediately afterward. This gap is often referred to as inefficiency or imbalance. Whenever you hear these terms, they are simply different ways of describing a fair value gap in price delivery. To make this clearer, let us look at an example. Here we have 2 price movements that appear very similar at first glance, as both move strongly to the upside. The difference becomes clear when we look closer. The example on the left shows a gap between the upper wick of the first candle and the lower wick of the third candle. In the example on the right, No such gap exists because the wicks overlap with the candle body. This gap is what defines inefficiency or imbalance. Even though both moves are strong, only the left example qualifies as a valid order block. To mark it, we take the candle just before the inefficiency and draw a rectangle covering the entire candle, from the highest wick to the lowest wick. The second rule is that an order block must remain unmitigated. In most cases, order blocks are considered a one-time use. Once price returns and touches the order block, even if it is only a wick, that order block is no longer considered valid and should not be reused. To illustrate this, imagine you identify a gap or inefficiency on the chart and decide to mark it as an order block. If price later returns and touches that zone, even if only with a wick, the order block is considered tested. Once tested, it is no longer valid and should not be treated as a fresh order block. Although there are approaches that reuse mitigated order blocks, those will be discussed in other videos. For now, the key idea to remember is that order blocks are generally treated as a one-time use. The third rule, and the most important one, is that a valid order block must lead to either a break of structure or a change of character after it forms. To apply this rule correctly, we first need to briefly revisit how market direction is defined. Because order blocks are validated by directional shifts in price, understanding whether the market is in an uptrend or a downtrend is essential. With that in mind, let's quickly review how market structure is used to determine direction. So, how do we actually determine whether a market is in an uptrend or a downtrend? Markets move through different phases. At times, price trends higher in an uptrend. At other times, it trends lower in a downtrend. And there are also periods of consolidation where price moves sideways and direction is less clear. In this video, we will focus specifically on trending conditions. Let us take an uptrend as an example. During an uptrend, the market does not move straight up. Instead, it moves in a structured way, forming what we call higher highs, usually marked on the chart as HH, and higher lows, usually marked as HL. They are called higher highs because each high is higher than the previous one, and higher lows because each low is also higher than the previous one. In contrast, during a downtrend, price forms lower highs, marked as LH, and lower lows, marked as LL. They are called lower highs because each high is lower than the previous one, and lower lows because each low is also lower than the previous one. In an uptrend structure, each time price breaks the previous high and creates a new higher high, this movement is referred to as a break of structure, commonly abbreviated as BOS. Of course, markets do not remain in an uptrend forever. At some point, the trend begins to change. This shift occurs when the previous lows are broken, leading to the formation of lower lows. Before this break, price was forming higher lows. Once those levels are broken, they turn into lower lows. This break of the previous lows during an uptrend is known as a change of character, often abbreviated as CHoCH. It is called a change of character because the market shifts from an uptrend structure to a downtrend structure, and the cycle continues. During a downtrend, price forms lower highs and lower lows. Each time a previous low is broken, that move is considered a break of structure, or BOS. Later, if price breaks the previous highs and forms higher highs during a downtrend, that move is again referred to as a change of character, or CHoCH. This is a brief overview of how break of structure, BOS, and change of character, CHoCH, work together to describe shifts in market direction. With that context established, we can now return to order blocks. For an order block to be considered valid, price must move with intention afterward, producing either a break of structure or a change of character. To see how this works in practice, let us look at an example. In this chart, price makes a strong move upward and leaves behind a gap or inefficiency, suggesting a potential order block. However, this alone is not enough to immediately draw the order block. We must first observe whether price produces a break of structure or a change of character afterward. At this stage, we can see that price has not yet broken the previous highs, meaning a break of structure has not occurred. Because of that, we wait and allow price to continue developing. Once price eventually breaks this high and creates a break of structure, that is the moment when we can draw the order block on the candle just before the inefficiency. In the next example, Price again moves aggressively upward, creates inefficiency, and then follows through by breaking previous highs. Since this sequence results in a clear break of structure, it confirms another valid order block that can be drawn. Now let us examine a different scenario. In this chart, price is producing higher highs and higher lows, and we can identify a potential order block due to the presence of inefficiency. However, because price has not yet formed higher highs beyond the structure, this order block cannot be considered valid at this stage. After some time, price moves downward and creates another possible order block, this time on the bearish side. This is visible through the strong downward move combined with inefficiency on the red candle. Shortly after, price breaks the previous structural lows, forming lower lows. Since this happens during an uptrend, it qualifies as a change of character, confirming that market structure has shifted into a downtrend. At this point, our focus shifts to the most recent order block that aligns with the new trend, which is the bearish order block. The earlier bullish order block is invalid because higher highs were never formed, while the bearish order block is valid due to the confirmed change of character. Now that we've explained order blocks and market structure, it's time to move on to the actual trading strategy. This strategy operates using 2 time frames, and we've simplified it into 5 clear steps. First, analyze the market structure on the higher time frame to determine the overall direction. Second, mark the key order blocks. Third, wait for price to pull back toward those zones. Fourth, look for a change of character on the lower time frame to confirm the reversal. And finally, execute your entry from the order blocks on that lower time frame. As mentioned earlier, this setup always relies on 2 different time frames. The higher one serves as your main chart for day trading analysis, and the lower one is used for confirmation, precise entries, and managing your active trades. It doesn't matter exactly which time frames you prefer to use. The important rule is that your entry time frame should be at least 2 times lower than your higher time frame. For example, many traders combine the 1-hour chart with the 15-minute chart, or the 4-hour with the 1-hour, depending on their trading style. The next important point is that this strategy can be applied to any market or asset class. It makes no difference whether you trade Forex, crypto, indices, or stocks, because price action principles remain consistent across all charts. Still, make sure to backtest thoroughly before trading with real money, so you can see how the strategy behaves under different market conditions. Now let's return to analyzing the market structure, which is the foundation of this plan. The very first step is to identify the market direction. Trading in alignment with the main trend almost always gives you a higher probability of success. To determine that direction, look for clear breaks of structure, changes of character, and recognizable reversal patterns on your chart. If you can't clearly see the direction on a specific time frame, it's better to skip that setup entirely. Trading when the market direction is uncertain only increases your risk. It's much safer and more effective to focus on instruments or pairs that show a clean, obvious trend. This allows for better decision-making and more consistent risk management. Next, we identify the fair value gaps and mark the order blocks, which serve as our main trading zones. At this stage, we can simply place a sell limit order at the order block and position our stop loss just above it. However, for a more conservative approach, it's often better to zoom into lower time frames once price reaches this area. That way, we can observe how the market reacts around the zone and confirm whether the trade setup is truly valid. We want to see a clear rejection from the order block to ensure that it is being respected. Even though this setup has a high probability, price does not always reverse perfectly from the box. The market can easily ignore an order block, so patience and confirmation are key. The next step is to wait for price to pull back into the order block zone, and then drop down to a lower time frame for closer analysis. Remember, never jump into the market before price actually reaches your zone. Many traders get trapped by entering too early, right before the market delivers the real move. Now, in the final step of this trading plan, we look for confirmation signals and execute the trade on the lower time frame. After price enters our zone, we need evidence that the short-term uptrend has ended and that the market is preparing to move lower. To identify this reversal, we look for a change of character. This occurs when price breaks below a recent swing low, confirming that the short-term uptrend is over and that momentum is now shifting downward, in alignment with the bearish direction from the higher time frame. Once this reversal is confirmed, we wait for the market to form new bearish order blocks on the lower time frame, and then take the trade. This is why the method is known as order block within order block. It's important to note that the lower time frame order block does not always need to be fully contained inside the higher time frame order block zone. After identifying the lower time frame order block, we place a sell limit at the start of that zone and set our stop loss just above it for protection. For trade management, we aim for multiple targets. The first target is usually a 1-to-2 risk to reward ratio. Once price reaches this level, we close half of the position and move the stop loss to break even. The next target is typically the first significant support or liquidity zone ahead of price on the higher time frame chart. Here's a quick recap for the bullish scenario. The same rules apply, but in reverse. We wait for price to reach our higher time frame order block. Then, we look for a change of character on the lower time frame, which occurs when price breaks above a swing high. This confirms that the short-term downtrend has ended and that buyers are now taking control of the market. Once this is confirmed, we look for new bullish order blocks forming on the lower time frame and place a buy limit order at the beginning of the zone, with the stop loss positioned just below it. Targets are managed in the exact same way as in the bearish setup, following a structured risk-to-reward approach. Now, before we move on to real chart examples, let's quickly review a few common scenarios and how to handle each one effectively. Scenario 1. A very small order block on the lower time frame. In this case, it's safer to use a slightly wider stop-loss area to protect your trade from normal price fluctuations. A stop that's too tight can easily be triggered by minor volatility, even if the setup is still valid. Scenario 2. A very large order block on the lower time frame. If we place our stop loss below the entire zone, it might become too wide and weaken our risk-to-reward ratio. Instead, we can either define a smaller protective zone just below the main block, or place our entry closer to the middle of the zone. Both methods help maintain a balanced and efficient trade setup. Scenario 3. Multiple order block formations. We can trade each one as long as they provide a reasonable risk-to-reward opportunity. However, it's essential to manage risk carefully. Never risk more than 2% of your trading account on a single position, and avoid having more than 3 trades open simultaneously. This discipline keeps you capital protected, even during losing streaks. Finally, always remember this: the goal is not to win every single trade. Losing trades, missed setups, and small drawdowns are all normal parts of trading. What truly matters is maintaining consistency, managing risk wisely, and finishing the day with a positive overall result. Now, let's look at some real chart examples to see exactly how to apply this trading plan in practice. Here we have the euro-dollar on the 1-hour chart. The recent price action shows that the market had been in a clear long-term downtrend until it suddenly shifted direction by breaking above this protected low. That break of structure represents a change of character, signaling that demand has taken control and that a potential bullish reversal, or the beginning of a new uptrend, may be underway. Since the higher time frame direction is now bullish, we're only interested in looking for buying opportunities. The next step is simple. Identify the fair value gaps and mark the order blocks. In this example, we can see 2 distinct fair value gaps. So we mark the candles that created those gaps as our order block zones. These areas become our key trading zones for potential entries. If the price pulls back into any of these zones, we'll then zoom into the lower time frames to look for confirmation signals before taking a trade. So let's see how this plays out. The price has just tapped into the first order block, so we switch to the 5-minute chart to search for an entry. On this lower time frame, we want to see clear signs of reversal, confirmation that the order block is being respected, before opening a long position. For confirmation, we look for a change of character on this lower time frame. This happens when price breaks above the swing highs that led to the previous downward move. Let's play the price forward. Here, we can see that price actually broke below the order block without showing a clear change of character. Although there was a brief reaction to the zone, it failed to confirm the reversal we were looking for, meaning there's no valid trade setup at this point. Now let's go back to the 1-hour chart. On this chart, we still have another unmitigated order block zone below. If the price moves down into this area, we'll once again switch to the lower time frame to look for a precise entry signal. Let's see how the price develops next. The price has now tapped into this order block, so we zoom into the 5-minute chart again. On the 5-minute chart, the market has already shown a clear change of character. Exactly the reversal signal we were waiting for. This tells us the short-term downtrend has ended, and we can now start looking for long setups with confidence. The next step is to wait for price to form bullish order blocks, and then use them as entry points. Here, the market creates its first bullish order block, so we open a long position. As price continues to push higher, another order block forms, but this time without invalidating the previous setup. We open a second long trade based on this new formation. This approach is important because the pullback to the very first order block doesn't always happen. Sometimes the market only returns to the second one before continuing higher. In the worst case scenario, the price could drop deeper and hit both stop losses. And that's why we always trade with reduced risk. Now, let's see what happens next. The price hits the stop loss of the second trade, but keeps moving higher, triggering the first one. A bit later, another order block appears. Once again, without closing the first trade, we take a new long position at this fresh order block zone. We continue repeating this process until the market reaches our target. In this example, the previous high on the higher time frame. This strategy has proven to be highly effective, but like any method, it must be back-tested thoroughly before you treat it with real capital. The truth is, even with a solid plan, you will still experience losing trades, and that's completely normal. Losing doesn't mean your analysis was wrong. The key is consistency. Now, everything we've covered so far gives you a complete and structured approach to trading order blocks. But once you understand this foundation, there are also more advanced nuances that can further improve your execution. In this next example, we once again observe a strong upward move accompanied by inefficiency, suggesting a potential order block. However, without a confirmed break of structure, this order block remains technically invalid. At this point, there is an important detail that can help improve how you use order blocks within your execution and overall framework. If we draw a Fibonacci retracement on this move, we can see that price reacts strongly within the optimal trading zone, which lies between the 0.618 and 0.786 retracement levels. If you are using the OTE concept and did not enter the trade when price initially retraced into this zone, you may still anticipate a potential reaction at this order block. Even though this order block remains technically invalid because structure has not yet been broken, it shows strong signs of behaving like a valid order block. In this scenario, if you had entered a long position in either of these situations, the trade would have resulted in a profitable outcome. Later on, we can see the formation of another order block, followed by an imbalance, forming within the OTE retracement zone. This sequence creates another high-quality area that can also serve as an excellent opportunity for a long entry. Before we wrap this up, we're going to briefly show a short clip from our video dedicated to the OTE concept. In that video, we explained how the optimal trading zone can be combined with order blocks, imbalances, fair value gaps, and other structural concepts. We strongly recommend watching the full video for a deeper and more complete understanding. Let us take a quick look. So, what is ICT's optimal trading zone and optimal trade entry? This is a structured trade entry framework built around price swings, Fibonacci retracements, and market structure. Its goal is to identify where a pullback is most likely to end, allowing traders to enter with precision instead of chasing price or reacting late. After a valid impulsive move breaks market structure, we apply the retracement tool to define the correction range, the optimal trading zone, located between the 61.8% and 78.6% levels, highlights areas where institutional participation is likely to return in the direction of the dominant trend. By combining market direction, price swings, and optimal entry placement with concepts such as fair value gaps and multi-time frame confirmation, this model creates a clear, repeatable framework for high-probability trade entries. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and CHoCH. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.